Howdy, Jacob here. Today we're looking at ConMed Corporation in the healthcare equipment and supplies industry. 2 billion market cap on just under 3 billion enterprise value. So another company with a bit of net debt, and they are a medical technology company that develops, manufactures, and sells surgical devices and related equipment for surgical procedures worldwide. Headquartered in Largo, Florida, incorporated in 1970. Growth is about 3 to 5% per year, compound annual growth rate of revenue over the last 10 years. Recently, pretty solid growth, 19% the last year. Very solid gross margin of 54%. Pretty consistent as well. Operating margin also pretty consistent in that 6 to 10% range. They do pay a dividend, haven't increased it over the last 10 years. So hopefully their margins have increased to where that payout has decreased, and a pretty poor return on invested capital. Balance sheet shows 24 million cash on hand, 1 million short-term debt, 973 million long-term debt. Not a lot of cash for my liking. I do prefer a company with a lot of cash on hand. I mean, similar to a person. I mean, I know a lot of people say if you want to maximize your dollar, it's good to just be fully invested, and quantitatively that can make a lot of sense. But from a realistic standpoint, what does Buffett say? Something along the lines of you'll see who swimming naked when the tide goes down. And so if you don't have cash on hand, that can easily occur. And so for them to have only 24 million cash on hand with 973 million in long-term debt, again, that debt could be due in 2 years. It could be due in 20 years. Probably not 20, but it's likely, they can build that cash balance up, but it doesn't look like historically they've had that big of a balance either. Just a statement. I prefer more cash on hand. Okay, free cash flow is pretty solid production with low capital expenditures in relation to cash from operation. They've made money every single year, so very big positive there. They made a pretty large net acquisition here, and it does look like it gave them an increase in free cash flow, so that's positive. We'll see if that can hold. You want to make acquisitions that don't just hit top line. You want it to hit the bottom line too. Make the company more efficient. The use of cash outside of every once in a while large net acquisitions is the dividend that pays out 1.2% yield is 25 million. Pretty reasonable payout. And then their debt reduction. So let's start making some assumptions on this business. As for revenue growth goes, I think I'd probably be comfortable with 5%. They do make some acquisitions every couple of years, so maybe they'll grow 2 to 3% organically, 2% from the acquisitions. So if they buy it every 3 years, maybe it'll be 6 to 7% from acquisitions every couple of years, whatever it is. As for margins, free cash flow is a lot more consistent, which I appreciate. Maybe 6.5 and 5.5 with share change of 1% would be 20 million. And they don't buy back shares, issue about that in stock-based compensation. So let's say a couple of those become shares. 1% seems reasonable to me. PE, price free cash flow on a company growing 5%, but low return on invested capital. Dividends the same. Acquisition, majority growth company, probably a little less than market average in my perspective. And with these assumptions, we're saying it needs to fall 70% before you get the return we look for here. So there's a lot of companies out there I think are much more fairly priced than this one. So I won't be wasting any more time here, but until it drops down to a price that looks a bit more attractive. Hope you enjoy the video and have a great rest of your day. Thank you.